I'm Diane Rosagnola, here in San Francisco at NAREIT's REIT World, our 2018 annual conference. I'm here with Jason Fox, CEO of WP Carey. Welcome, Jason.
Thank you.
WP Carey recently announced a $5.9 billion merger with Corporate Property Associates 17, one of your managed funds. How will this improve the company's earnings quality and strengthen its credit profile?
Yeah, it really falls under three categories. One, strategic benefits, portfolio benefits, as well as the impact on our balance sheet. From a strategic standpoint, we're going to have a shift in how we generate our earnings. Historically, it's been more 80-20 earnings from our real estate portfolio and 20% coming from our investment management platform. That's now going to shift 95-5, which will make us more of a pure play net lease REIT and a simplified company for that matter. And really the benefits are simple. The earnings from real estate are higher quality, more recurring, and will receive higher valuations than those that we earn from our investment management platform. I think the portfolio benefits, we're buying a very high quality portfolio, one in which we've managed since inception, one that we know very well, and we're buying at a very good valuation in and around a 7% cap rate. And because we've managed it for such a long time, there's really zero integration risk, which is quite rare for a merger of this size. And it's really going to enhance all of our metrics as well. Our diversification is going to increase, which is important to us. The weighted average lease term of our portfolio is going to increase to around 10.4 years. We're going to have a lower percentage of our top 10, so we're going to add diversification there as well. And then we're going to have some scale, which are all great benefits. And the third benefit to the CPA17 transaction is its impact on our balance sheet. It's going to result in lower leverage for our balance sheet from a consolidated debt to gross asset standpoint. It's also going to add higher quality earnings, which is going to provide better coverage to our dividend as well as our interest expense. It's ratings neutral, so we're still investment grade rating, no impact on that. And then lastly, it's going to add scale, which will add further protection to our bondholders, but also provide more growth opportunities either through larger portfolio transactions or some potential M&A as well.
Speaking of diversification, WP Carey is one of the largest diversified net lease REITs. How does such a diverse portfolio help insulate the company from local market disruptions?
Yeah, diversification has really been a core part of our business for a long time, and it helps us really insulate ourselves from any downturn in one particular industry or geography. In addition to how we structure our leases, it does provide that downside protection.
And what do you anticipate in terms of investment opportunities heading into 2019? Well,
it's a competitive market, but again, I think diversification really kind of helps how we can grow. We can allocate capital to where we see the best risk return opportunities across tenant industries, asset classes, and geographies. This year in 2018, we've been a little bit more skewed towards Europe, where we've seen great spread opportunities given the low cost of borrowing. I think in the future you'll see it shift back to a more balance between the US and Europe for that matter. Now, new acquisitions really aren't the only way that we grow. We also have a good profile of rent increases. 99% of our leases include rent increases. Out of those, about 2/3 of them have increases indexed to inflation. So we really have a hedge against rising rates to the extent there is correlation with inflation. I think on top of that, we also have a very broad installed base of assets. And one of the hallmarks of how we operate is to be very proactive on the asset management side. So we're able to source what I call as internal investment opportunities, expansions, CapEx projects with tenants where we're able to put money to work at very high yields because we have a captive investment opportunity, but also we're able to extend lease terms and add criticality to the assets themselves, all which are great benefits. And then I think lastly, because of our scale, we'll be able to do some larger portfolio transactions and even potential M&A. All of this should lead to a lower cost of capital, so any investments that we are doing should have a more accretive impact on our earnings.
Thanks so much, Jason.
You're welcome.
For more from REIT World 2018, visit REIT.com.